major websites. The word deep state is now spiking on Google Trends, and Trump's approval ratings have gone down to about 36%, the lowest in many terms in office for many presidents, which have an approval rate averaging 63%. So this is very low. We've had a series of 3 Bitcoin interviews and 3 marijuana legalization focused interviews. The U.S. is changing, Europe is absolutely changing, and we're in for a very interesting upcoming 4 years. Today, I'm thrilled you've joined us because as we're speaking, with New York Times best-selling author of Currency Wars, The Death of Money, The New Case for Gold, and The Road to Ruin. He has an extensive background in global finance and politics and is one of the most sought-after commentators in the world. Jim Rickards, how are you? Where am I catching you today, Jim?
I'm upstate, up in New England, up in the mountains, in one of my studios, and it's great to be with you, Lior.
Listen, Jim, I want to get started with what's working in today's market. What are some of the most attractive assets for 2017?
Well, Leo, the way I think about it, I have what I call a permanent portfolio, which is just a way to allocate wealth. It's what I do with my own money, and I recommend it to investors, that is robust to just about everything that could happen. I'm more of a global macro strategist. I'm not a stock picker. I don't recommend, buy this sector or that sector in particular. But my permanent portfolio would have, basically, it would be allocations of your investable assets. Now, I should define that term, first of all. Investable assets is the amount of money or savings that you have to invest, not including your home equity and your business equity. I don't think people should treat their homes as portfolio investment. I know a lot of people do. It's a big expenditure, but it's not something you really want to gamble with or take chances with or over leverage. Same thing with your business equity. If you're a dry cleaner, car dealer, doctor, lawyer, dentist, you run a pizza parlor, restaurant, whatever, that's your livelihood. So you don't want to really speculate with that. So take your home equity and your business equity, put it off to one side. Whatever's left over, those are your investable assets. I recommend 10% of that in physical gold or silver. I think silver also performs very much the same function. Not 50%, not 100%. You shouldn't go all in on any asset category, but I think 10% is the right amount. I expect gold to go up by a factor of, perhaps 5 to 10 in a matter of years. I'm not talking about 20 years, I'm talking 2 to 3 years in the next global financial panic. That's something I talk about in my books. My most recent book, The Road to Ruin, and also just coming out this week is the paperback edition of The Death of Money. It was a 2014 book, but it's just coming out in paperback now with new material. So I talk about this in those books, and the point I make is that if nothing bad happens, and let's hope for that, you won't get hurt with a 10% allocation. But if a lot of these other asset categories collapse, that 10% gold and silver is your insurance. I also recommend cash, a large allocation of cash, maybe 30%. People are surprised to hear me say that. They go, "Wait a second, Jim, you're the guy talking about the death of money. Why would I have cash?" The answer is I might not have it forever or for very long. But in the short run, it's kind of an underrated asset. It doesn't have a very high yield. I understand that, but it has a lot of embedded optionality. If things start to fall apart in other categories, the person with cash is able to kind of come in, pivot with better information into something that's doing well, or pick up bargains if some other sector is falling out of bed. I also recommend private equity, art, fine art, land, real estate. I think these are all assets that in various ways will hold up to inflation or deflation. And that's an important point because we could have either one. The stage is set for either one. There are certainly forces in place pushing in both directions. If you definitely knew inflation was coming, investing would be easy. You'd go buy gold, silver, land, you'd leverage it up. That's easy. If you definitely knew deflation was coming, you'd have cash, you'd have 10-year treasury notes and some other assets that are robust to deflation. But what if I said we're right on the knife edge? It could tip either way, which I think is the best way to describe the system. So you would want some of both. I call this the barbell approach, where you have inflation hedges like gold, silver, and land. you have deflation hedges like 10-year Treasury notes, and then connecting the two ends of the barbell, you have cash, which gives you a lot of embedded optionality.
That's a great point, and it's an all around like a 4-season portfolio. I want to ask you a few things about it. Private equity. The thing I love about that, collectibles, art. Obviously, collectibles have been one of the best performing assets of the last 5-6 years. I mean, you talk about like Ferraris and Lamborghinis from the 50s to 60s. They've gone up to insane valuations. And what I also like about that, all of these and real estate, is it's off Wall Street. It doesn't matter what the financial sector is doing. These are uncorrelated assets. Is that part of the reason why you like private equity? Following that question regarding cash, 30%. The reason that you're feeling comfortable with this is because you don't expect something that is going to crater the entire plan overnight. People are going to have time to prepare. If they see inflation start creeping up, they can unload some of that cash into other sort of assets. And just to clarify, when you say factor of 5 to 10 in gold, you mean 500 to 1,000%, correct?
That's correct. So I've got gold going to my intermediate target price is $10,000 an ounce. That's not a number that I made up or I pull out of a hat or I mentioned just to get publicity or attract attention. It's actually the result of a careful study of the implied non-deflationary price of gold in a financial panic. If you had a financial crisis worse than 2008, which is what I expect. I think you can see that coming based on the system dynamics, the scale of the system, the concentration of banking assets, the amount of derivatives, the interconnectedness of the system. There are lots of reasons, and I discuss all this in detail in my book, why the next financial crisis will be worse than 2008. So if something like that comes along, you're going to need a solution. You're going to need a way to both restore confidence and reliquefy the world. Now, we're at the point where central banks are tapped out. I mean, they took their balance sheets. I'll use the Federal Reserve as an example. They took their balance sheet from $800 billion to over $4 trillion to deal with the last crisis, but they have not normalized it. They haven't gone back down to $800 billion or even $1 trillion since the crisis is over.
What's the risk in that? What is the risk for them to have such a large portfolio?
Well, one risk is that if you have another crisis tomorrow, what are you going to do? I mean, you're going to double it again to 8 trillion, 12 trillion. Where's the confidence boundary? I mean, legally you could, and a lot of modern monetary theorists, MMT people, Professor Stephanie Kelton, Paul McCulley, and others think that that's exactly what you would do. You would just print more money and take the balance sheet to 8 trillion or 12 trillion. I don't think that will work. I think that there's some you can't specify the exact number, but there's some confidence boundary where people just say, you know what, I'm out of here. This system's crazy. I don't believe you can keep printing. I want to dump my dollars and get into some of these other hard assets. So that's where the price would begin to spike. But there is one other source of liquidity in the world, potentially, which is the special drawing right. That's world money printed by the International Monetary Fund, the IMF. It sounds kind of geeky and complicated. That's partly by design because they don't want people to understand it. But simply put, the Federal Reserve can print dollars. The European Central Bank can print euros. Well, the IMF has a printing press. They can print these SDRs. But unlike the other central banks I mentioned, they're not highly leveraged. The IMF is only leveraged about 3 to 1. The Federal Reserve is leveraged 113 to 1. So they're kind of tapped out. But the IMF could issue trillions of SDRs to provide the liquidity to kind of bring the system back from the brink of panic. But of course, that would be highly inflationary, and that's when the price of gold would skyrocket. The other alternative to SDRs is gold itself. You could use gold either as a strict gold standard or some kind of reference for money supply to restore confidence. That might work, but then you have to wrestle with the price. People say, there's not enough gold for a gold standard. Well, that's nonsense. There's always enough gold. It's just a question of price. I mean, at $1,250 an ounce, no, the existing amount of gold If you try to base a money supply on that, you'd have to reduce the money supply. It would be highly deflationary. But if you took the price of gold to $10,000 an ounce, and again, I've done the math on this, it's pretty straightforward. That would be the right price to support the money supply with 40% gold backing. So these things are feasible, but they all point in one of several directions. Either you use the SDR solution, which is inflationary, or you raise the price of gold, which is inflationary, or you just print a lot of dollars. They all end up basically creating inflation just in three different directions. So that's why you want gold as your insurance. But it won't happen overnight. I mean, the crisis could come up very quickly. I do caution people that they should get their gold now, not just because the price is attractive, but because you can get it. It's available. If you wait for the panic, I think there will be signs of this coming. I agree that it won't happen in one day. There may be an acute phase that happens in a matter of just a few days, but you'll see it coming, as was the case in 2007. I mean, I was warning about the financial panic of 2007, 2008, years before, and then even in 2007, I could see it was going to get a lot worse. So you can see these things coming, but most people, they're kind of in denial about it. They don't want to really hear about it. They wait until things do get out of control. But you'll find the next time that you actually won't be able to get the gold. It won't be a matter of price. The price will be going up. You'll see it on the internet or on TV or on CNBC, and it's going up, a couple $100 per ounce per day. And you'll say, oh, gee, I better go get some gold. But you'll find that you won't be able to get it. The dealers will be sold out. The mint will be back ordered. So the time to get that is now. Now, Leo, on your earlier point about private equity and collectibles, I mean, those are two separate asset classes. When I say private equity, I'm talking about investing in companies, but not listed companies, not companies on the New York Stock Exchange or the NASDAQ, but, startup companies, technology companies, natural resource companies created by entrepreneurs where you can know the person you're investing with. It's still a form of investing. You're buying stock, but you're not relying on a stock exchange or an index or a broker for your liquidity. It's really just a contract between you and the entrepreneur starting the company. I think there are some attractive opportunities there. A little bit hard to identify, but the other one is fine art. I'm not necessarily a big fan of what people call collectibles, whether it's wine or Lamborghinis. Fine art, yes, but that's because fine art has a very, very long track record, really thousands of years, as being a very good store of wealth. The problem with a Lamborghini, it might go up, the dollar price might go up, but it's not liquid. I mean, try selling it in a panic, you won't be able to, or how it would preserve wealth through thick and thin. So the model portfolio is really gold, silver, land, cash, fine art, and private equity. I'm not saying don't have anything in the stock market, but I would keep that allocation relatively modest. And most of all, be nimble, stay informed. I mean, none of these things are set it and forget it portfolios. They're a good place to start, but things are changing daily. I think the fact that Trump's selection as president is a very significant change in the financial landscape in terms of potential response functions to future panics. So you need to, as I say, stay alert and stay nimble.
Let's break down the biggest risks for the average person. Let's separate the question into four groups: the retirees, the people that are working but have insufficient savings right now, and then the third group would be basically people that are working and they're in peak earning years, so 35 to 55, 65, and they have they have money working in the markets, they have allocations. And the fourth group would be the millennial generation, just starting out, getting out of college. What would be the risks to these four groups separately? And more important than risks for listeners, what are some of the solutions that you're suggesting for people who are retiring right now, for people who are in low-paying jobs and just don't have a lot of savings, and then people that are that do have money but are afraid to risk it or lose it, and then the millennials that are now they're experiencing this new populist president, not just in the U.S., but Europe is spreading to be more and more populist, and jobs are changing like never before. I mean, latest statistics are 6 jobs, 6 careers by the time you're 44. You're going to change 6 careers. It's almost insane. So what are some of the risks and solutions you see for these 4 groups?
Well, the easiest group to deal with, the one with the least risk, is the group that has no savings. And that's because, as Bob Dylan said, if you ain't got nothing, you got nothing to lose. In other words, they're not going to lose in a market crash because they don't have any significant amount of stocks or bonds or savings. So it's not good that they don't have savings, but they're insulated because they're not exposed to the markets that are likely to crash. For that group, the biggest risk is inflation, which is to say, you have a paycheck, you're living, week to week, you get your pay, you pay your bills, whether it's a mortgage or rent, buy groceries, you don't have a lot left over and you don't have a lot in the bank. So you're not going to get hurt by a stock market crash because you don't have anything in the stock market, but you could get hurt by inflation. And for that individual, I would say, to the extent they have any savings at all, you might want to put a little something into gold and silver. I was in Las Vegas not long ago, and I was in a taxi. I was there to speak at an investment conference, and struck up a conversation with the taxi driver. And I said I was speaking at a conference, and so we kind of got on the subject of financial advice, and I was saying, well, if you have $100,000, put $10,000 into gold or silver. And she just cut me off. She said, look, all I have is $10,000. That's all I have to my name. And I said, well, look, just go buy one gold coin. At the time, gold was about $1,300 an ounce. So that was, a little more than 10%. That'd be 13% of her savings. But so just buy one gold coin, put it in a safe place. And that's your insurance against inflation. That's your insurance against, things like the banks closing or extreme financial risk. So even for people of modest means, some gold or silver does have a place. Now, for all the other groups you mentioned, Leo, you said they're in different demographic brackets. Some are already retired. Some are kind of mid-career, late career, and then the millennials are earlier in the career. I would say they all face exactly the same risk, which is a systemic collapse. Look, if systemic collapse doesn't happen and life just goes on and you have normal business cycles, then all the financial advice you hear on TV and elsewhere is pretty much correct. The thing they recommend is when you start out younger, have more in the stock market, and as you get older, shift from stocks to bonds because you want to take less risk. You want more certainty as to your income. And people say, well, if the stock market goes down 30%, nobody thinks that's good. Clearly, it's bad. But if you're young enough, they say, well, it'll come back. And look, the stock market crashed in 2008, was down 50% or more. But it's back to those old levels and even higher today. So for someone who didn't panic, didn't sell, held their stocks in 2008, they've made all that money back and then some in the meantime. So that's the conventional wisdom. That's what your wealth managers tell you. That's what your robo-advisors tell you. They're actually programming robots to dispense this advice, all based on these simple formulas that I'm describing. What I'm saying is completely different. I'm saying, no, we're in a different world. We're in a world where the systemic risk has never been greater. The next financial crisis will be unprecedented in its magnitude. The capacity of central banks to deal with it is diminished, if not completely gone, because they've wasted so many of the resources and credibility dealing with the past crisis and haven't normalized things, and that we're looking at an extinction level event in the next financial crisis. And to back that up, again, when I say things like that, some people kind of roll their eyes and go, well, you're just a doom and gloom. No, I mean, this is all science and it's all documented. In my book, The Road to Ruin, for example, that's the book that came out in November 2016. I take the readers through 2 prior crises, real events, 1998 and 2008. I make the point that in both cases, we were just hours or days away from the complete collapse of the entire financial system. In 1998, I actually negotiated the bailout. That was a hedge fund called Long-Term Capital Management. I negotiated that bailout with the Wall Street banks and with government officials, Federal Reserve and Treasury. So I had a front row seat on that one in 2008. Again, followed that very closely. But here's the point, Lior. In 1998, Wall Street bailed out a hedge fund to save the system. In 2008, the central banks bailed out Wall Street to save the system. In the next crisis, 2018, if not sooner, who's going to bail out the central banks? In other words, each crisis gets bigger than the one before, or each bailout gets bigger than the one before. The risks get greater than were the time before. We're now at the point where the central banks won't be able to bail us out because they haven't normalized since the last time. So who's going to bail out the central banks? Well, there's only one clean balance sheet left, which is the SDR. But again, the minute you talk about special drawing rights or gold or what I describe as the Einstein solution, where you actually shut down the system, you money market funds suspend redemptions, you close the stock market, you close the banks to buy time to come up with these solutions, which I think is the most likely outcome, at least as a short-run solution. These are, we're looking at the greatest financial catastrophe ever. We're outside here history and experience. We are outside the capacity of central banks to deal with it. So in these extreme outcomes, it doesn't matter if you're 75, 55, or 25, all of your normal financial assets are going to be either wiped out or suspended or reneged or inflated away. And if you don't have some of the big three, which would be precious metals, art, or land, you're going to be wiped out. So I think all those groups are facing the same risk from this, what I call extinction level event or threat to capital markets.
Okay, well, with regards to what you're saying about central banks being out of tools and out of options, Ray Dalio, the world's largest hedge fund manager by far, recently in front of central bankers and other top commercial bankers, where he was invited to speak in New York, he told them, look, I've actually calculated how many months the system has left with what you're pursuing here, with the debt levels that you're accumulating on the government side. And when this debt load becomes too excessive, he said that he expects direct injections to bypass the financial sector and basically reach citizens to encourage them to spend as their next phase. He said this was a phase before helicopter money, but he said populism and the impatience of people in the middle and in the lower classes is becoming apparent. It's now inside of the political system. They are looking for solutions, and therefore he sees these types of direct injections, which lawfully he said there are many ways to do it. He says this is the next step. How deep in the demise of this current system are we that we're talking about this, and do you think this is something that's plausible? Obviously, we're talking about one of the most vetted people in the financial sector ever.
Well, I know I met Ray and I follow his work, and actually my first book, Currency Wars, was one that he selected. Each year there's a kind of entry-level group coming into Bridgewater, which is the name of his hedge fund, and it's a very interesting place, a very strong culture. It's not to everyone's taste, but one of the things Ray does, he picks 2 or 3 books a year and encourages his, or actually requires his entry-level employees to read them. And in 2012, he picked my book, Currency Wars. So I guess that was one that had some impact on him. But see, what he's talking about, we're talking about slightly different things. They are related. The short answer to your question is we are very deep into a process by which the system will collapse. So very little doubt about that. And again, these are not just claims. There's a lot of math and science to back it up, having to do with scaling metrics. And again, I talk about all that in my books. I'm talking about the response function. So I'm saying, okay, so the crash is here. What is the reaction function? How do governments react? What can they do? That's when I get into gold and SDRs and the things we just talked about. What Ray is saying is, well, can you head it off? Are there things you can do today to keep the system from collapsing? He's also looking at a different kind of collapse, a little more political than economic. He's talking about, the rise of populism, and he looks at populist regimes in the past, whether it's Juan Perón in Argentina, Adolf Hitler, Benito Mussolini, and others. And what he's saying is, in effect, in almost classic Keynesian terms, you've got to stimulate aggregate demand. We've got 2% growth. We seem to be stuck there. It's no surprise, growth is nothing more than the sum of increases in the working force times productivity, right? So how many people are working? How productive are they? That's all there is. And so one's growing about 1%, the other one's growing about 1.5%. You multiply them together, you end up with this kind of 1 to 2% growth that we've seen since the end of 2008. And how do we get? But the problem is our debt is going up 3.5% a year. So if your growth is going up 1-2%, and your debt is going up 3.5-4%, and about to get worse, and you compound both of those things, you can see the debt crisis coming. So that's the basis for Dalia's forecast. So what he's saying is, get the debt under control if you can, but if you can't, you got to get the growth up. And what he's saying is, you can either use helicopter money, or the other thing that's in the air is called the GBI, or guaranteed basic income. This is basically giving people money whether they work or not. Just government saying, hey, here's some money. And I'm not talking about welfare or food stamps. We're actually talking about substantial amounts of money, meaning maybe $15,000, $20,000 a year to people without jobs, or who are not making that much money, or maybe just give it to everybody. Even if you are making money, you get this guaranteed basic income. And that's what he means by direct injections. And the idea is that people will go out and spend it, and that'll increase aggregate demand. There'll be a multiplier. We'll get at least nominal growth, if not real growth, going. And that's one way to deal with the debt crisis. What's interesting about that is I hear that from the left and the right. You hear it from people on the right, like Charles Murray, from Washington think tank, very well-known author, public intellectual. You hear it on the left from people like Bernie Sanders and others. I would put Ray Dalio, I don't think of him as left or right. He's a bit of an analyst and iconoclast, but so let's just say we're hearing it from left, right, and center. So this is definitely one of these things that's coming. I mean, Joseph Schumpeter talked about it 50 years ago, writing in the, or more than 50 years ago, writing in the 1930s and 1940s. He thought this was where society was going, but he predicted it 50 years in the future. He said in the 1940s that we would be socialist by the year 2000. I think we are socialists. We just don't realize it. But this is sort of the ultimate realization of that. So I don't disagree with Ray's analysis, but we're looking at slightly different things. He's saying, how can we head off a crisis? And his answer is, let's increase aggregate demand by giving away money. What I'm saying is, we're not going to be able to head off the crisis. It's going to happen. And how do we survive it? My answer is, have some physical gold and silver. Thoughts on cryptocurrencies, Jim? Yeah, I watch them. I look at the technology. I've been engaged with United States Special Operations Command down in Tampa to kind of interdict ISIS using cryptocurrencies to finance the Islamic State. So I'm pretty familiar with it. I separate the technology and the currencies. I think the blockchain technology has a future. In fact, it's already being rolled out and implemented in a number of platforms led by JP Morgan. There's another new company, Blythe Masters is involved with, former head of commodities trading for JP Morgan. The Winklevoss twins are involved. Mark Andreessen, one of the savviest venture capital investors, startup investors, is involved. So a lot going on with blockchain technology. Bitcoin uses the blockchain, but it's a separate currency. So I think I'm bullish on the future of blockchain, but not as enthusiastic about Bitcoin. At least I don't recommend it for portfolios. What I would say there is that the problem with Bitcoin, it was invented in 2009. And so we haven't seen how it performs through a business cycle yet. We've had nothing but global expansion since Bitcoin was invented. Now, it's been a weak expansion, but an expansion nonetheless. So Bitcoin has never gone through a business cycle. Bitcoin has never gone through a recession or a depression or a financial panic. So I think it's untested as far as that's concerned. So I think blockchain technology has a future, but cryptocurrencies, I'm more in a wait-and-see mode. Now, okay, I get that. I want to ask you this: Do you feel that, in my life I've been part of a few wars just because of where I grew up, etc. Do you think there's a real chance that these currency wars
will escalate into physical conflicts?
Well, they already are. I would say the answer is yes. I mean, the history is that currency wars turned into trade wars, and then when things get bad enough, trade wars turned into shooting wars. That was the exact history of the period from 1929 to 1939, and then on into World War II through 1945. So that's exactly what happened there. But what's new is that we're seeing financial warfare not as the result of other economic developments, but as a means of attack, as a kind of a first line way of attacking your enemies. I think the financial wars are front and center. It's going on. We have several financial wars going on right now between the United States and Russia. This is after Russia annexed Crimea in 2014 and incurred. There were incursions in eastern Ukraine, which are ongoing. The U.S. did not want to strike back kinetically. Nobody thought it was a good idea to drop the 82nd Airborne into Sevastopol. So instead, we responded with economic sanctions. Vladimir Putin correctly understood that as an act of war and has responded with cyber financial attacks on the U.S. These are now escalating. Looks like North Korea was behind the diversion of $81 million of the reserve positions of Bangladesh held on account of the Federal Reserve Bank of New York. We're seeing new cyber financial sanctions being imposed on Iran. Iran at one point was kicked out of SWIFT. SWIFT is it's based in Belgium. It's the kind of the central nervous system of the global financial system. It's the message traffic system for almost all major financial money movements in the world. We actually kicked Iran out of that. That's like cutting off the oxygen supply to a patient in intensive care. Just the other day, North Korea was kicked out. Threats to kick out or banks elsewhere that do business with North Korea. So we're seeing financial cyber warfare all over the place. So it's not, I would say it's not coming. I would say it's already here.
Understood. Jim, thanks very much for taking the time and sharing with us some of this important political and financial point of views and practical advice. I personally bought and sent your latest book as a gift to a good friend of mine who's now 18, and I wanted to get him off to a great start in life and make him more knowledgeable. Could you tell folks where to find your work, your books, just so people can plug in and go there?
Thank you. The latest release, the book is called The Death of Money. This book actually came out in 2014, but it's out in a new paperback edition with new material out this week. So that's available on Amazon. But all the books are available on Amazon or Barnes & Noble online or your independent bookseller. So it's Currency Wars, The Death of Money, The New Case for Gold, and The Road to Ruin. So those are my 4 books, and also my website, jamesrickardsproject.com, and very active on Twitter. My Twitter feed is at James G. Rickards, and I put out a lot of financial information there as well.
Jim, thank you very much.
Thank you.
Jim Rickards is regarded as one of the top commentators on the fiat monetary system, mainly because he has studied it as much as anybody else. We began the interview by creating an asset allocation model, which can tackle any economic condition we end up facing, inflation or deflation. At wealthresearchgroup.com/2017, I created an exclusive report with my personal diversification and portfolio for 2017. Download it so you can gather ideas for your own portfolio. Regarding immediate risks, James sees total systematic collapse as an inevitable outcome to these excessive government debt levels and makes the case for gold and real estate. We just created a really juicy special report on these subjects of risks and safe havens and a unique real estate strategy that my partners and I personally used to generate $3,000 to $5,000 on average per deal using none of our own money, with the average deal taking about 3-4 weeks between 2009 and 2013, which I think will be very beneficial for you to learn and utilize in your backyard market, wherever you live. This is a recession-proof strategy. I urge you to take some action in your life because no one will do it for you. Download our important publications at wealthresearchgroup.com safe havens for a combination of a myriad of safe havens that you should implement in your portfolio. wealthresearchgroup.com/Bitcoin, where we cover Bitcoin and a new cryptocurrency that we believe can make a remarkable upside in 2017 and beyond, because it's set up in a very unique way. I'm almost completely sure you haven't heard about it. It's under the radar right now and pretty new. wealthresearchgroup.com/deals for a step-by-step manual of exactly how we do these deals. We then spoke about the prospects of more intense stimulus measures and the need to own gold and silver. Jim says that gold could rise by 500 to 1,000%. Wealth Research Group has uncovered a company that's absolutely sitting on gold, proven 43101, and the true major catalyst is that it just IPO'd and it sits on the same area as a super major mining company from China that could easily take it over with the slightest positive results from continued drilling. We will announce the full profile of this company this Sunday, so April 2nd, and you can get the complete research on it at wealthresearchgroup.com/gold. Lastly, regarding the debt ceiling and the fear of escalating tensions on the political front, I suggest you sink your teeth into this documentary we created called June 1st, Deep State to Overthrow Trump, and get the special report connected with it at wealthresearchgroup.com/national debt. I want to thank you for joining us week in and week out, learning more and more, increasing your financial fortress, and stay tuned as we have an epic April and May ahead of us.